And welcome to The Bottom Line, where we unpack some of the main business and economic stories of the day. Today we have the opportunity to discuss a more detailed analysis of the IMF staff report for the Article 4 2024 consultation that took place towards the end of last year. Today we're joined by Geoff Gottlieb, IMF Senior Regional Representative for Central Eastern and Southeastern Europe, to give us a more insight regarding the details for the key findings for Poland and what it means for the country for 2025 and beyond. Hello, and thank you very much for joining us today. It's good to have you back.
Thank you for having me.
So I just want to give a little bit of context for our viewers. Inflation rates in Poland are expected to exceed 5% in January, but economic growth forecasts are looking positive. And your IMF report presents 3.5% growth levels in 2025. And obviously, those are going to be boosted by EU funds. And we've just heard from the National Bank of Poland that interest rates will not be cut probably until the second half of 2025, if not beyond that. The IMF sees this hawkish approach as accordingly appropriate. We have some Polish economists, such as Rafał Benecki at ING, who disagree with this and express concerns that these cuts might actually come too late. Why is this the case? And could you elaborate perhaps on the IMF's opinions regarding that?
Sure. I think it's worth stepping back a bit and thinking about what we're trying to achieve. We've just been through a massive inflation shock, both in Poland and abroad. It's not just unique to Poland. And people are understandably upset. Households are struggling with the cost of living. Firms are struggling on how to invest. So I think that this is a major challenge that needs to be addressed. Where are we now? Inflation is still well above the target, and it's expected to rise in the near term. In addition, we see the underlying pressures, particularly from rising wages and unemployment being very low, as still there. So what does the central bank have as a tool to address this? It's mainly the interest rate. And interest rates can either be tight, which helps lower inflation, or they can be loose, which helps increase growth. And so what the goal is to do is to reduce inflation so that people are confident that inflation will stay low, not just now, but also into the future. And so right now, what we see is that the interest rates of the central bank are on the tight side. And we think that's appropriate until two things that we're looking for. We're looking for inflation to start moving down towards the target, and we're looking for less pressure on wages, because that ultimately drives inflation back. Based on our current forecasts, we see that inflation will probably peak in the first half of next year and could start to come down after that. And we see scope for cuts to begin maybe in the middle of next year, 50 to 100 basis points. But it's possible. It's possible that it would have to happen sooner. It's possible that it would happen later. So the key is that we stay focused on the data and adjust as needed.
Regarding fiscal policy, we know that the government intends to bring its deficit down, but is the policy sufficient as it stands?
Well, I think it's important to take stock of where we are. The deficit right now in 2024 was almost 6% of GDP. This is quite high, especially given that the economy is quite strong. Why is it high? It's high for very well-known reasons. Social benefits were increased, wages were increased, defense spending was increased, and the interest bill was increased. So what they've announced is a very encouraging first step. They've announced that the deficit will go from 6% almost 6% in 2024 to just below 3% in 2028. So this is very encouraging. I think we would make three comments on where we think that this could be strengthened. The first is we think the deficit should probably settle closer to 2.5% rather than closer to 3%, because this would put debt on a downward trajectory. Second, we would like to see more of the adjustment happen sooner rather than later. That would also help relieve pressure on inflation and allow interest rate cuts to possibly be sooner. And the third thing that we're looking for is more detail on how it will be done, as that would increase credibility around the adjustment. But I want to be clear about the main point. We don't think that fiscal adjustment should compromise economic growth in a major way. We see major opportunities for public investment to be strong. So we think the adjustment should be done in a way that preserves very strong public investment. The goal is not low debt at any cost. The goal is to preserve investment and help the most vulnerable groups while keeping debt low. One bit of historical perspective, debt was very low going into COVID, and that served the country very well because you'd have a strong policy response. And so striking this balance between keeping debt low and doing the critical investments is the challenge for the next few years.
And obviously securing growth, that is a massive priority, especially given the economic situation in the region. Poland obviously leads with its growth forecasts in the EU and in the region, undoubtedly a goal for this year. What should the key areas of focus be to ensure that this growth actually happens?
Well, I mean, two starting points. I mean, one is economic growth track record in Poland is fantastic, and that's not just since 1990, that's also since 2019. Per capita income is up 20% since 2019. So there's a lot to be proud of. I think looking into the near term, we also see very strong reasons to be optimistic. Part of it is what was mentioned in the previous piece, which is that EU flows are very large and are going to be concentrated in 2025 and 2026. Another reason to be optimistic about the near term is that wage growth has been strong and there is scope for private consumption. But where our concerns are really focused is looking a little bit further out. If you look domestically, we're seeing price pressures on wages, which hurts competitiveness, energy, which hurts competitiveness, and overall demographic pressures. And then if you look abroad, there's challenges, structural challenges to growth in Western Europe, as well as rising fragmentation. So the question is whether the economic model that has served Poland so well can continue. And we see a couple priorities in terms of how to ensure that. One is on the labor side, increasing labor participation, particularly female labor participation. The other is doing more with what you have in labor, which is better job training and better job matching. And then on the capital side, there's also several things. One is making sure that the EU flows are dispersed. And the second is making sure that the regulations are adequate to tap into very large green capital that's available globally.
Will Poland become too dependent, though, on those EU funds? Because, we have to keep in mind that the economic landscape in the region actually needs that investment very almost urgently, I would say, perhaps in Poland as well.
Well, I'd say there's two parts to that. One is to make sure that public investment does not fall after the RRF funds end in 2026. And in order to do that, there needs to be more fiscal adjustment. So we definitely think that domestically...
Can you elaborate just very briefly on that fiscal adjustment that you would recommend?
Well, there's two types of fiscal adjustment. There's the kind of fiscal adjustment that you do in order to lower the deficit. And then there's the kind of fiscal adjustment that you do in order to increase priority spending in other areas. So the total amount of adjustment you need to get to the deficit of 2.5 is different than the amount of adjustment that you need to increase investment, which would be still more. So that's the key, is that for everything that costs money, which is cutting taxes or increased spending, it really needs to be judged against this challenge of keeping debt low and increasing priority investment spending.
But that suggests quite a number of changes, actually, to ensure that after those EU funds stop flowing in, Poland's in a good spot.
There's no question, but the government has outlined the first key step, which is an ambitious adjustment program, and now the key is execution.
Very briefly, as we wrap up, you include in your report with confidence that fixed capital formation should increase and stay at a higher level than today. To what extent can that reliably change Poland's investment landscape, especially by the time that those EU funds run out?
Well, it's certainly a start. I mean, one of the big puzzles in Poland is how economic growth is so high with investment levels that are so low. And of the investment that is done in Poland, very little of that comes from banking and credit. So there's no question that to reduce the gap in the capital stock between Poland and the rest of Europe, there needs to be an increase in investment. And green investment seems like an obvious area, given that emissions per capita are very high in Poland. But again, Poland has had a fantastic growth track record and very high productivity growth. The next step is getting investment to a level that will help sustain that.
Okay, Geoff Gottlieb, we're going to have to leave our conversation there. Thanks so much for joining us today.
Thank you for having me.
And we were joined by Geoff Gottlieb of Warsaw's IMF office. Thank you so much for joining us today. I was your host, Marie Cato. Join us every weekday for Business Arena at 5 p.m. CET on TVP World. And for the latest in regional business, follow us on X and on tvpworld.com. And for more news and features, stay with us on TVP World. Goodbye.